Welcome to Session 4 of our course on Financial Market Regulatory Practices, FMRP. In this session, we will be diving into governance, risk management, and compliance, which are crucial elements for ensuring the smooth and fair functioning of financial markets. These practices help ensure that institutions operate with integrity, transparency, and in full adherence to regulatory requirements. Let's begin by looking at the big picture why these three pillars, governance, risk management, and compliance are so important. 1. Overview, governance, risk management, and compliance. Governance refers to the framework and structure within which decisions are made and actions are taken in financial institutions. It ensures that there is effective oversight and accountability. When governance structures are in place, there is a clear chain of command, with roles and responsibilities well defined, making sure that the organization operates efficiently and ethically. Risk management is a framework that financial institutions use to identify, assess, and mitigate various risks, market, credit, operational, and legal risks. Without effective risk management, financial markets can become unstable, with unchecked risks causing significant losses. Risk management frameworks allow institutions to proactively manage potential issues before they become bigger problems. Compliance ensures that all market participants and financial institutions adhere to legal and regulatory standards. Compliance is necessary to prevent violations of laws, such as insider trading, market manipulation, and fraud, which can damage the integrity of the market. Regulatory bodies, like the Monetary Authority of Singapore, MAS, enforce these standards to ensure fairness and transparency in the markets. 2. Key points to remember. Let's now look at the key points that underline these areas. Governance structures. These structures ensure that financial institutions operate with proper oversight, minimizing the risk of misconduct, fraud, or operational inefficiencies. The board of directors, for example, plays a crucial role in overseeing major decisions and ensuring that ethical standards are upheld across the organization. Risk management frameworks. Risk management frameworks are designed to help financial institutions monitor and manage various risks. This includes assessing potential market risks such as fluctuations in asset prices, and credit risks, the possibility that a counterparty might fail to fulfill their obligations. These frameworks are essential in keeping the market stable and secure for all participants. Compliance. Compliance ensures that institutions adhere to local and international regulations. This includes laws about financial transactions, reporting standards, and anti-money laundering regulations. By ensuring compliance, organizations protect themselves from legal liabilities and contribute to a fair and transparent market. In the next section, we will take a closer look at the details of governance structures, risk management frameworks, and compliance standards in financial institutions. Now we will explore the governance structure in financial institutions. In this section, we'll discuss what an effective governance structure looks like, why it's important, and how it contributes to the overall integrity and transparency of financial markets. Let's begin by understanding the definition of an effective governance structure and why it is essential. An effective governance structure is a framework that ensures proper oversight and supervision within a financial institution. It is designed to make sure that decision-making processes are transparent, accountable, and based on sound, ethical principles. A strong governance structure is critical because it creates the foundation for market participants to operate responsibly and effectively, reducing the likelihood of misconduct and operational inefficiencies. It allows the organization to make informed decisions and ensure that both market and regulatory standards are met. In essence, the governance structure is the backbone that supports all operational activities and ensures that there is oversight at all levels of the organization. 2. Key features of an effective governance structure. Now, let's look at the key features that define an effective governance structure. Proportionate to the complexity and risk profile of the participant. The governance structure must be scaled appropriately according to the size, complexity, and risk exposure of the organization. Larger, more complex financial institutions may require a more rigorous governance framework, with multiple layers of oversight, detailed reporting mechanisms, and committees focused on specific risk areas, like market risk, credit risk, and operational risk. Smaller institutions might have a simpler governance structure, but it must still provide the necessary oversight to ensure compliance with regulations and prudent risk management. Transparent and competent for market oversight. Transparency is a key characteristic of an effective governance structure. All decision-making processes should be clear and open to scrutiny. This transparency ensures that stakeholders, including investors, regulators, and clients, can trust the institution's operations. The governance structure should also ensure that there is competent market oversight, meaning that the institution can monitor market conditions, trends, and risks effectively, enabling regular information gathering for informed decision-making. A governance structure should include systems and processes that enable the regular gathering of information. This information is vital for making well-informed decisions at the top management level. Financial institutions should have access to key data on market conditions, operational performance, and risk exposures so that management can assess and respond to changing circumstances quickly. 3. Key information for top management. Top management needs accurate and timely information to make informed decisions. Some of the key information that should be made available includes market risk exposure. This includes metrics like value at risk, which helps measure potential losses based on current market conditions. VaR provides an estimate of the maximum potential loss an institution could face in a given time period, with a defined level of confidence. Time buckets. These are used to understand the exposure over different time periods and help management understand how risks evolve over time. Counterparty and operational risk exposure. Counterparty risk refers to the risk that a party involved in a transaction might default on their obligations. This can be a major concern in markets with high leverage or large exposures. Operational risk involves risks arising from failures in internal processes, systems, or people, and it includes issues like fraud, system outages, or human error. Operational risk from electronic platforms and legal recourse. As financial institutions increasingly rely on electronic trading platforms and other digital systems, there is growing exposure to cybersecurity risks, technical failures, and legal issues. Governance structures should address these risks by having robust contingency plans, ensuring data security, and adhering to legal standards to mitigate potential lawsuits or reputational damage. In the next section, we'll explore remuneration structure.